Okay, so you want to get into multifamily affordable housing, but you don't know where and how? So listen today to Jarod and Dayne Conley's approach on how they selected their market and how they did all the running so you know how to spot a deal. Today on this episode of Affordable Housing and Real Estate Investing, we are going deep. We want to make sure we provide you guys with the details so you guys know how to look at a deal and how to approach it. So without further ado, Dayne, Jarod, and my guest co-host Andrea. Welcome to the show, everyone. How's everyone doing today?
Welcome, welcome.
We're good.
Doing great. Thanks for having us.
I love it. So this is one of the part of the deep dive series that we're having on multifamily affordable housing. Dayne, Jarod, they were so nice to offer their time and actually recognize that there was a need in the market and in the industry to talk really deep about this stuff. Sometimes in podcasts, we only talk about how many thousands of doors someone has, but no one actually talks about like, hey, how did you actually look at this deal? How did you actually analyze this deal? Why are you taking this deal in the first place, given all the rising interest rate environment? So let's maybe start there, actually, Dayne and Jarod. Like, Jarod, we wanted to understand, hey, what are the different market cycles there are that the audience needs to be aware of? And how did you guys adjust your debt strategy, your CapEx strategy based on those market cycles?
Yeah, definitely. Thanks for the repeat question. I think in general, we're looking at properties before we even consider anything related to the details of the properties, just knowing where are we in the cycle. Real estate tends to be cyclical. It's not a complete up and down. It's sort of like a gradual increase, and it sort of plateaus and then drops. And so we always want to know, are we in more of like an upward trend? So essentially where properties are selling, the days on market are low. You have, usually multiple offers, things like that. And then, you get to more of a plateau phase where properties are staying on the market longer. You're maybe not seeing this recycling of properties like we saw, over the last couple of years. Is like somebody owned it for maybe 18 months and they're already turning around and selling it for a significant premium. And so you see less of that. More of a valuation based on the actual performance of the property and not kind of numbers that sometimes you're trying to figure out how on earth did they get that value, to then, an actual dip or decline where you may see cap rates in your area actually increase, which effectively should decrease the value of the property. And so we're trying to factor that up. And then once we know where we're at or where we think we're at in the market cycle, we then want to make sure we have debt that matches up with that. So for instance, if we feel like, the market's red hot and maybe the good times are coming to an end here in the next year, 2, 3, then we need, debt that's going to be longer term. We don't want our rate to adjust or the term to come due in a downward trending cycle, because if that means the value is going to decrease, you could be in trouble. So we're matching that part up. And then I guess the flip side of that would be if the market's super hot, maybe we'd get a little less risk averse and say, hey, we'll take something that's the rate's going to adjust in 3 years, or maybe it would balloon in 3 years because we think we're just going to fix this thing up and essentially flip it anyhow. And then along with that, kind of the third piece is just what are we going to do with the property? Most of what we do is try to buy and hold long term. But again, I think when there are opportunities, would we consider selling something? We actually did that with our initial property. We bought our first property ever. We ended up selling in kind of that frenzy stage where things were selling. And so we want to put all those together, where we think we're at in the market, what sort of debt do we need, and then what's ultimately our goal or exit strategy with the property, and align those together.
I love that you talked about lining up the debt with the cycle, because not a lot of people think about that, right? So when you said, hey, maybe when the market's really hot, you might be, a little bit less risk averse, but help us relate that to the audience, right? A lot of folks are understanding of single family homes. And when the industry was really hot, you saw people, maybe they were looking at offers based on what the loan product that they were getting, meaning, hey, I'm probably going to choose this offer because this person's putting 25% down instead of 5% down. So which means they have a little bit more reserves, right? Did any of the folks or sellers that you guys worked with looked at the loan product you guys were pursuing in order to close on a property and factor that into the decision? Or is this completely different because it's commercial? Tell us a little bit about that.
Yeah, it tends to be a different beast with it being commercial. The sellers are kind of setting their price based on input from their broker, and if they have their own internal analysis that they're running, and then really it kind of feels like it's kind of up to us to find the debt product that would allow us to purchase the property, or if not, then we just need to pass on it. And then, to kind of come back to those three things we're looking at, I think it's just a big takeaway point is you can't really take the same strategy or apply the same strategy. You have to kind of be thoughtful of where you're at and make sure you're matching up your strategy with how you're going to buy it, how you're going to own and operate it, and eventually, sell or exit the property with those. Because, for instance, if you're a fix and flipper, let's say, and you buy something at the peak of the market, then it starts to drop. Like, that's a bad situation to be in. So I think that's sort of the single family home analogy is if you're just taking the same approach, eventually the market cycle is going to burn you. And so you have to be thoughtful where you're at.
And the only thing I would say on that, Kent, is the sellers don't look at what product we're using, but they want to know that we're pre-approved or that we're a qualified buyer. So there are times where we'll present a pre-approval letter or something along those lines, so that they know that we're serious, we have the funds, and we're players and qualified.
I love that. The fact that you guys are adapting so well to the market and making sure that you're conservatively underwriting. I feel like I face that too, where you're wondering, should I go into this deal even if the cap rate is lower than the interest rate? So these are questions you have to ask yourself as an investor. But so Camp share with me recently that you guys closed on a 36 unit deal in August, I believe. How did you guys conservatively underwrite for the interest rates that have already risen to like 6% plus or 7%? How are you guys adapting to that different type of environment? Are you basing it on increasing basis points in your exit strategy, or any other way?
Yeah, that deal, the debt on that deal was a moving target up until honestly, up until like a day before closing. And that was a strange deal because there was so much up in the air, and not sort of standard or typical, I would say, of sort of our past purchases. But that one, the LTV ended up shifting from like 80% to 75% over the course of us, sort of submitting an LOI and then closing. The other thing that changed too was this had some CapEx that needed, we wanted to bake into the loan. And that was one of those last minute surprises where, if I remember right, I think the terms were essentially like the loan amount was going to be the lesser of either, I think it was 80% of the purchase price or 75% of the kind of after repair value. And it came back lower than what we were expected. So our CapEx we were hoping to bake in and had done previously without any issues at all. Really, we weren't. We had to essentially just bring extra funds at close and have them held back for these capital improvements that we wanted to do. And then along those same lines, we actually still got the rate pretty decent. I went back and looked. The rate was like still 4 3/4. But it was more like the LTV that had changed, or in this case, kind of the loan to cost ratio that changed on us. And so that required us, coming up with more capital at closing, which we actually had a partner on this deal, which was not a fun conversation to have. So it was the first time we ever did a deal with this particular partner to say, hey, I know you were supposed to bring in X, but we need you to bring in, that plus some extra money.
That's great that you guys had that conversation with your investor. Are you finding with capital expenditures that you have to allocate for that preemptively with a certain amount? Or are you finding that whenever you guys do go under contract, are you having a property manager assess that CapEx or a general contractor? How are you guys going about that?
Yeah, so that's some of what I do. Jarod does all the number crunching, thank God. So he'll be doing the majority of the talking today. So before we close, I'm out there, boots on the ground, walking every unit, obviously walking the exteriors with our property manager. And we put together a to-do list for each unit, what we think we're going to have to do. And then we just kind of put together, we get quotes on that. And whether it's a roof or, parking lot, whatever it may be. And then, we'll present that to the lender and have it baked in.
Amazing. Love it.
It does
Got it.
reduce the sting a lot, instead of having to then, close and then come up with even more money to get those repairs done. It's baked into the loan and it makes it much more manageable.
I mean, how did you guys approach that conversation with your investor? Like, hey, we need more money.
That's a great question. I was just going to say, I think every time we've been on this podcast with you, Ken, we always say we only run with good dudes and dudettes. And thank goodness this was a really good dude. Somebody that it has a very, very, very high net worth. You would never know it because he's just a dude, has grown up in multifamily. That's all he's ever done. He's specialized actually in affordable housing, him and his family. And so he got it. He understood. He really didn't give us any kickback or question anything. Because again, Jarod was on top of explaining why we were where we were. And so, yeah, that's why we run with good people.
And I think that I really need to emphasize that point you guys just made. Not only are you guys, investing with good people, but you had like a philosophical alignment, or you're picking your investors wisely. Some folks out there nowadays, they might just be like, oh, whoever's willing to give me money, I'm just going to take it. But they don't understand how much work it is and the responsibility and the burden you must take on and carry on your back when you're taking money from other people. Having a very difficult conversation like this, where you're doing a capital call, where you're in the beginning of the deal, like that could sour a lot of relationships if you guys don't manage it well and communicate that effectively. And knowing that person had experience in multifamily, that probably made the conversation a little easier from the sounds of it. So maybe let's talk through the deal a little bit, right? It was like a very changing environment. So how did this deal come to you guys? And tell us a little bit about, you mentioned you had a partner. Like, at what point did you bring the partner in? Like, did you guys do a lot of due diligence first and then brought them in? Or, hey, deal came through, you guys talked to the investor right away, and you're like, okay, we think we have enough capital here, and then let's try to underwrite it a little bit more deeply. Tell us a little bit about that. How did the deal come up in the first place?
Yeah, we had a broker bring the deal to us. It actually had been sitting there for a while. So that was kind of one of the early signs of, hey, the market's changing, because it wasn't under contract in like 3 days. And it's in a secondary market where we had expressed some interest. And so we decided to take a look at it. And that's, this sort of broker relationship is 100%, to Dayne's credit. He does an awesome job of just networking with people, and is just his genuine self. And I think that's where he can make that connection, is he's not trying to act like, we are some company that we're not, and just shows his true self. And so this broker has been super kind to us and sent us, several deals, including this one. We like the market. And then similarly, the investor is someone Dayne had been, he was introduced to, and put in a lot of time and effort just talking to them and building up that relationship. And Dayne always would say, I don't know why this guy wants to do business with us, but for some reason he really wants to do business with us. Because as Dayne mentioned, this guy's is an incredibly high net worth individual, and you feel like he could take his money and kind of do whatever he would prefer to do it. And so we were super humbled that he would want to invest with us in our mission to provide good, clean, affordable housing.
Yeah, and it was an area of Columbus where there's a tremendous amount of potential growth. We're not afraid of secondary markets and things like that. But this was a rural area. And so we had some questions and concerns, did our due diligence. maybe even more so than usual, because it wasn't in Columbus proper, it was just outside. And funny story, our property manager grew up in this town. And so, once we remembered that, we had done our homework, and then we went with him and said, oh gosh, we forgot you grew up here. What do you think of this deal? And he was all for it. I think, one, because he didn't have to leave his backyard really to get to the properties, but also he knew that it was a good deal. I don't think it was a grand slam, but it was a solid double or triple with a potential for being a grand slam. And that was reassuring also. But, working with our partner on this, I don't get intimidated or awestruck when I meet celebrities or, whoever. I was intimidated with this because I know how to underwrite, and and I know the numbers, but Jarod, that's his specialty. It was a little intimidating at first for me, being face to face. We went to, well, you can see it in the background here, some Columbus Crew games together and talked business, and it was a struggle for me initially, but then you just realize, like, hey, we know what we're doing. Just stick with the foundations of what we do. Don't try to promise the world, and present the deal as the deal, and just be upfront and honest. And it worked out great. And I'm hoping we can do, many, many, many more deals. And I think that's where I felt the pressure was. I wanted this to be a grand slam, so that this person that we kind of look up to and has the net worth that we would love to tap into from time to time also, we want to prove ourselves to him and make him money and make him happy.
Yes.
And since we've closed, he's been nothing but laid back, and, oh, hey, could you send me the monthly numbers, and understanding that the first year is the first year. It's not 5 where we're doing a cash out refi. We're still stabilizing and putting money in, and so when you're upfront and honest and straightforward with an investor like that, I think they can do nothing but appreciate it.
And I love that. I'm so thankful you're being honest that you felt intimidated, right? Because that's just like the feeling of growth. That's like, I tell people all the time, when I signed my first real estate deal, I was nauseous that whole night. I was throwing up. I couldn't I couldn't eat that night. And now when I have friends that are doing like big things, I was like, and they're like, I'm nauseous. I was like, dude, I felt that before. That's the feeling of growth. And I'm so glad you called that out, so that our listeners, when they're about to sign their first deal and they're feeling nauseous, they were like, okay, I remember hearing about this from Dave and Jarod.
Yeah,
for sure. And just revisit your numbers and take a deep breath. Go back to your principles of the underwriting, and make sure that you're not, pencil whipping the deal, that you're not making it work by taking unnecessary risks. That conservative underwriting. And if it still makes sense and you're not forcing the deal, then yeah, go for it.
No, completely agree. And I want to make sure I ask this question, right? Because you guys mentioned you guys were entering a secondary market. That's going to be very similar to some of the newbies out there where they're entering a new market for the first time. And you mentioned you guys had some concerns. What were those concerns, and what was addressed by the property manager versus you guys just being very conservative in your underwriting?
I think one of our biggest concerns was we were leaving the nest. We knew Franklin County, Columbus really well. We had great connections with Section 8 there, and this was going to interrupt that playbook of how we kind of approached previous deals, which was looping them in, getting an idea on maybe what we could get on the rent side. And we had to build all new connections, even though it's one county to the east.
Yeah, and just with it being a smaller, more rural town, you have some concerns like, okay, what's the primary industry in that, secondary or tertiary market, and how stable is that? And if that production plant or whatever it may be goes out of business, how does that affect us? Now, that was not a big concern for us in this market because it was relatively close to Columbus. Still, there was tremendous growth that was just announced, headed out in that area. So we felt comfortable taking that risk. Yeah.
I want to add to that. I feel like I feel the same way as any one of you probably did with your first deal. You're just nauseous. You're like, oh my God, am I analyzing them numbers correctly? Did I do enough homework? So at some point, did you guys ever experience that where you wanted to get out of your paralysis analysis mode, and then finally when you took that jump, you're like, oh my God, okay, we're doing it. So the real work, do you feel like it started when you're underwriting or after you close the deal?
That's
oh man, yeah.
The deal, the work for me, from my standpoint, is so front loaded. The 2 or 3 months before the deal closes, for me, being on the ground, on the property, walking it, negotiating it, all that back and forth, getting estimates for any CapEx we're going to do. It's a lot for me early on. Jarod does the underwriting, and that's a lot. But boy, that's a great question, because then you got to carry out the game plan, So I think it's truly in the affordable housing space. Now, we're not buying an A-class property where we just turn the lights on and we're good to go. I think it's 12 to 18 months of work, and then it starts to get a little easier. I don't mean to cop out. That's a great question. I don't know. Maybe Jarod will say something different.
We want to put in the hot seat.
I always think it's after. I mean, when you get the deal, there's a lot of work that's very time sensitive. So that makes it feel hard, because you're trying to get you through your due diligence. But then it's after. And especially when we have investors, that I personally feel an extra level of pressure to deliver. Because you can make numbers on a spreadsheet look like whatever. You then have to go take that plan and execute on it. And so that's where I always feel it. And then to the point earlier of feeling nauseous about deals, I mean, we've bought several. I still feel like that every deal. And I heard one of our mentors, they own like over 1,500 units. And he said still, and they don't syndicate, they buy it all kind of with their own personal capital. He said still the night of like closing, essentially, he doesn't sleep, he feels sick. I'm like, okay, good. So I think regardless if it's deal number 1 or, deal 30, there's the butterflies that come with making a big decision. There's always that fear, or, to your point, Kent, actually it's more likely a growth opportunity, but you kind of perceive it as fear.
I mean, do you experience that often? I honestly experience that anytime I'm about to do any kind of a presentation on underwriting. And I mean, just to put you in the hot seat, how did you underwrite these deals, like step by step? Is there a process in which you go through, or a template, or is this just something that you feel you're like, let's go and figure this out together?
No, we have a methodology. When we're going to evaluate a property, we kind of, again, at a very macro level, if it was a new market, we would make sure it kind of checks the boxes for, population growth, job growth, median income growth, et cetera. And then, once we know, okay, hey, we're going to invest in this market. If we're looking at a deal, we check like the median income in the area, just to get a sense of what's it like in that general neighborhood. We then, we touched on, kind of market cycle, the debt and the exit strategy. That's always at the top of our underwriting sheet. So it sort of forces us to think through that first before we then jump into the numbers.
Right.
I think it's tough, especially early on. Like you can get so caught up in the numbers that you forget some.
Uh-oh. Another blooper reel. He's from. He
You're
always
gonna remind
phrases
him
it
where
nice,
he left off. Oh, I love
that's
that.
funny.
That's great. But he has a really good approach to it, just originally on the market cycle.
Yeah, right.
Dane, do you help him out when it comes to doing some of the groundwork to tell him, hey, it doesn't look like, this is our major employer in the area, or maybe, do you actually take note of major employers in those locations
Yeah.
just to help them out?
Yeah, absolutely. So he does the majority of the underwriting. I always underwrite also, not as detailed as he does, but especially early on when we were buying our first couple deals, we would actually sit down and compare my underwriting to his and make sure that it was close. But yeah, now that's a lot of what I do is not just drive the complex, but drive the areas and do the research on local employers and sometimes the broker can provide that information for us also. But yeah, we get a real good feel for the neighborhood. Not just employers, but what are the surrounding single family homes look like? If we can buy the ugly duckling on the block, then that's sometimes a good thing because we can bring that up to whatever what the neighborhood is in terms of cosmetically and then financially and get good people in there too.
I mean, it sounds like you guys are doing a targeted market analysis from what it sounds like. And especially in Section 8, from what I've found, we do have to focus on the median zip codes because that's going to determine the type of rent that's acceptable to HUD for these Section 8 properties, just based on the rent comparability studies. But are you finding that you guys are looking out for not just median rents, but also like fair market rents, or you're also considering maybe some income restrictions for those types of asset classes?
Yeah. So, the nice thing with Section 8 here in Columbus is they have their whole formula. And we, as we talked about day one, when I met with them, I wanted to learn how they operated. And so we kind of use that formula and we'll reach out to them from time to time to find out what, before we close on the deal, what they'd be willing to pay per unit, 1 bedroom, 2 bedroom, 3 bedrooms. And we kind of stick very closely to what Section 8 would pay. We keep it affordable. And that's the thing. Sometimes the entrepreneur or the business person in us gets, I don't want to say greedy, but gets excited. Oh gosh, across the street, that B class just raised rents to $1,100 a month. But that's not our vision. So it's a balancing act. But we base a lot of it off of what Section 8 would pay, what the going rates for other comps are, and try to stay in that realm for sure.
Have you guys worked with any of those third-party report analysis people or appraisers to be able to provide you with the rent comparability studies or any kind of comps for the area? Or is this just something you guys get from your broker when you preliminarily purchase the property?
Yeah, it's mostly from the broker. Yeah, I would say we've never used a third party. Actually, one of my best friends from undergrad, her husband does that. So early on, I think with our first deal, him and I grabbed lunch, and I said, "Please tell me that we're doing this right. Tell me what do you think of the neighborhood?" And he does the whole needs analysis also, and he gave some confidence to us there. But yeah, we go basically on what brokers present. I almost always then double check that with an independent or another broker that we deal with who may not be involved in the deal, just to make sure that the rents, that the pricing, it makes sense. For sure.
I love that you guys have been able to bounce ideas off of you and work with those relationships you've already pre-established. That's awesome. And before Jarod knocked off, I was like, what's going on? He's explaining to us deep dive about how he approaches these properties. But I'm really happy that you guys can collaborate with one another. I mean, Jarod, are you finding that right after you get these expected gross potential rents, are you looking into the expenses or doing just a quick napkin underwrite once you do the underwriting?
Yeah, I think we, with time have been able to figure out a way to kind of somewhat like with a reflex or knee jerk, kind of reaction to say like, is this one worth looking into or not? And so, yeah, we'll do just a quick kind of back of the napkin, just, hey, what does this pencil out like? And then if so, great, we'll spend some extra time in there. And then, I think Dayne had mentioned it. We sort of underwrite it independently, and I try to do a more in-depth analysis, especially since we hold them long term. Try to do like maybe a 7 to 10 year projection, because the first year or so it may not always look great, but over that longer haul, and if we have that mindset of holding them long term, we want to have an understanding of what it looks like.
Yeah, and there's so much collaboration between him and I, and everything we just talked about, Andrea. Various brokers. I feel like I sleep well the night before. Maybe I'm just too dumb to be concerned, but yeah, I feel that night before, it's almost like the night before a big exam in college or in grad school, where I've studied, I've done all my homework, I know the stuff inside and out. I'm very confident going into the test, and if it's meant to be successful, it'll be successful. But if it fails, if we fail the exam, it's not because we didn't try and we didn't do our homework. We'll learn a lesson and move on. So yeah, there's a lot that goes into it for sure.
Nice. I'm very happy to just listen to how you guys collaborate and can work with each other as a team. It's not just your relationship as brothers, but also the relationships you guys have fostered over the years with brokers, appraisers, friends of friends,
Right.
private money. Well, we call them investors, essentially. We can't call them private money lenders in commercial real estate, because essentially, I mean, have you guys drafted a PPM at some point, or a private placement memorandum, after you've done the underwriting? Or is that something that you're doing once the LOI is submitted? I mean, how are you guys going about putting that out to investors when you're underwriting the opportunity?
Yeah. I mean, it's interesting. So we've really done deals with essentially like friends and family. So people we know, and have known typically for quite a while. So we actually don't have like a set drafted document. And in fact, we've never actually structured the deal with partners the same way twice, more than once. Essentially, we try to really customize it to the needs of the people in the deal, obviously factored in with the deal and what we need to get out of it as well. And really and truly, kind of like the core thing we do is we just want it to be fair for everyone involved in there. We don't want it to be like, hey, let's use these people for their capital so we can have the deal, and we're going to give them 5% equity or whatever. We want it to be super fair. We want it to work well, and ultimately want anyone in a deal to come back and do a second or third or fourth deal with us too.
Love that. And I wanted to make sure I call out the point where, Dayne, you guys mentioned like you guys kind of do your own independent underwriting, where one person might go off and do their own thing, but you guys might come back together and have a meeting of the minds. What type of value add opportunities like do you guys look for during the underwriting process? Is it just increasing rents? Because we've heard in like market rent properties, people add in pet fees, people add in parking fees, people add in, renting washer dryers from the main apartment. That might not apply to affordable housing, right? So what kind of value add opportunities are there, and how did you guys talk through them and incorporate them during your underwriting?
Yeah, I mean, I'll start on that. I think a lot of it are your basics. Like, can we bring rents up to fair market, affordable market rents, and is there upside in that? Obviously, is there ability to bill back for water, or like you said, pet fees, utilities? Is there a RUBS program in place? a lot of the basics right there, I think. And then as we're developing and becoming more efficient, we had this talk late last night, a few hours ago, with our investors. We did our annual meeting, and we keep saying efficiency. We want to get more efficient every year, and so that's something we've learned this year is partnering with a group that will insure the tenants, so that if they break their lease and leave early, or they do damage to the property, that repair and maintenance budget's going to go down, because that insurance will cover us. So that's another way where we can, quote unquote, make money, by not losing money. So it's a lot of your basics. Yeah. The first thing I think we always look at is, where are the current rents, and what can we bring them up to and still make it affordable. And then, like I said, all the other basics, but we're also learning every year, like, oh, this is a great way to be more efficient and not lose, not have to shell out $3,000 or $4,000 to fix this apartment, or have an apartment vacant for 3 or 4 months while we get it turned.
Yeah, I'd say the other thing, we want to look for too is just, can we run it better? Probably one of the best deals we've ever bought. It was just really heavy on the expense side, and we were able to look at those expenses and sort of compare that to some of our other properties and how they were running, and also loop in our property managers to say, like, gosh, what do you think repair and maintenance would be on a building like this, having walked it? And those are nice plays, because you can save money, day one, without having to invest any money into the building. Usually if you're going to bump rents, that typically comes with vacancies and unit turns, and that costs money. And certainly, we're all about reinvesting back into the building, but I think sometimes looking for those opportunities to run it more efficiently, or don't cost any money and are nice plays. So yeah, that's the only other thing I would piggyback on top of what Dayne said.
I mean, speaking about running it more efficiently, are you guys originally looking at the expense ratio and where it should be operating at? Or do you just go line by line with all the expenses and see if they're really necessary, if they need to be bumped up in the underwriting?
Kind of both, honestly. Like kind of that knee-jerk test is just the expense ratio, and then looking at kind of the various line items, which we sort of group into bigger categories. But to see, like, what is their repair and maintenance cost, per door, and what do we think we can do it as? Obviously, we've been using the same management company for a while, so we've gotten really familiar with, what to expect from certain expenses. And so if we isolate those, then we feel pretty confident there. And then we usually, again, we'll have that conversation with our management company, just to make sure that they're in agreement that that's, if we think we can be 70% of that number, let's say, that they think that's a reasonable target too.
That's so interesting that you're able to bounce that idea off of your property management team. All those ideas on how you can efficiently operate the property. And are you finding that it's helped you or benefited you finding a property manager that's been able to operate at higher occupancy, and then you can trust them more in these types of deals?
Yeah, I think honestly, finding a management company that knows, like, affordable housing, knows that space well, is very efficient in how they run their operations. They're familiar with Section 8. I think that for us was the key thing. And then, over time, working on our relationship with them in terms of, how we would like our properties run, I think has been great.
Yeah. And not just how they're run, but how we analyze the property pre-purchase. Do you think this is a good area of town? Yes or no? And we get interactive with them on that. And like I said, I'm on site with the property manager. I don't deal with electric. I don't understand electric. I don't want to touch electric. So we don't even have to have that discussion. He goes right to the electrical box and is making notes. I'm looking at everything else, and we're making notes, and it's a collaborative effort. And it is very it's really slick and really nice now. Now, not every property management group will work with affordable housing, and that's been frustrating because as big as Columbus is, there's some great property management groups out there that we've interviewed, but once they find out what we specialize in and where we are in Columbus, they don't go into those areas. That I think it's a lot easier to manage an A-class property. We're lucky to be where we're at for sure.
Wow, that's amazing. You guys are so right about that. Any types of when you're comparing market rate deals to Section 8, you definitely need a great operator, a good property manager to be able to provide that documentation. Because are you finding that the process for rent increases or certifications of tenants are those are different versus market rate, right?
Yeah, for sure.
Yeah, 100%. It's completely different. And I think we shared this previously. I mean, in Columbus, the Section 8 program has been outsourced to a third party. So that added a whole nother wrinkle. Whereas where this 36 unit property is, it's still, the Section 8 still has their voucher program that they manage internally. And that's certainly our preference. Is just one less layer of sort of redundancy there. But yeah, the approach we take is definitely completely different for like a voucher tenant through Section 8 than a market rate tenant. Usually takes a little bit longer because you have to have like the unit inspected, and if it doesn't pass inspection, those issues need to be remedied before they move in. So I think from just like an efficiency standpoint, it's definitely less efficient initially to move in a Section 8 tenant, or most of the time, because of that inspection piece. However, I think we find our Section 8 tenants, they're sticky. Once they move in, they tend to stay. And so for us, it is worth a potential dip in efficiency to maybe that unit's vacant an extra week or two to then have a tenant with us who, we're hopeful and optimistic will stay with us, multiple years.
Yeah.
Awesome. Thank you guys for that. There's just a whole process that we're all learning step by step whenever we're working with affordable housing. And it's just something that takes years to develop. But the fact that you are underwriting for that, all the variances, and also, are you guys finding yourself underwriting for potential inspections or pre-REAC inspections, or maybe a refinance appraisal? I mean, how are you guys going about, potentially underwriting for those safeguards?
Yeah, again, just with that relationship with our management company, we kind of know their base fee that they charge us, and then there's sort of a second set of fees that come with things like inspections, and we essentially just blend all that together to try to give an idea of what that's going to cost from a management standpoint. We on our underwriting document, it's all under our property management, but we essentially have it broken out between sort of the base management fee and then their sort of next level, and work with, again, that good communication with our property management company to ask them, does this number seem right for any potential inspections that are going to be coming up, for whether it's for Section 8 or if we do like a cost segregation study, a refinance, anything like that. We try to get their input on that. And that's just, anyone new out there, or even if you're, experienced investor, I think it's a simple thing, but just that communication piece, and not just making the assumption that, oh, the management company will do this, and this is what I think they're going to charge us. It's actually, no, ask them and get their input. And then they're more engaged and you get a true answer, and everyone's on the same page.
And I love that you guys set clear expectations. And I think there's been a common theme here, right? Where you guys are working very closely with the property management company throughout the whole thing. We've heard of market rate apartments where property management companies charge like between 3 to 5%. What's the range as a percentage of gross rents are you guys seeing from your property management company? Is there a specific number, a range, like 6 to 8, 3 to 5? What are you guys seeing in your numbers, and what are you guys using to underwrite?
Yeah, we've actually even shopped around Don't tell our current management company, by the way. No, we've even shopped around other management companies just because I think that's, again, another critical part. We're happy with who we have, but I think you always want to know just what are your options and is there a better fit? I would say kind of for our portfolio size, 6 to 8% is, the numbers we hear. If it's going to be a percent of collections, the other model that's been presented to us is more, you're paying for the property managers and maintenance tech salaries, and then maybe a much lower percentage of rent. So maybe, 3 to 4%, but then you're paying essentially, the employees that are working on your property, their salary, their benefits, et cetera. So it can be either or, but if it's straight collections, 6 to 8%, I think what we see.
Got it. And now that you guys are up to 168 units, right? We've heard of people where there's a rule of thumb, like maybe you have a maintenance person every 40 to 75 units. Do you guys actually have someone full-time on staff now, or are you guys still relying on the property management company to kind of take care of these ad hoc work orders for repairs?
Yeah, I knew you were going to go there. I thought you were going to talk about going vertical because that's something Jarod and I had talked about. And then being an entrepreneur and having multiple businesses in the past, the best thing about the businesses are your people. The worst part of the business is the people, because there's payroll, there's workman's comp, so we had looked into that, and I was like, man, I don't want to do that again. So we are completely dependent on the property management group. But again, it's communication. If we're going to take on another 76 units, they're in the loop on that. They know that it's coming so that they can start to add more staff for sure. I mean, it's a process to get to closing, and they're part of that, every step of the way, and are able to grow their team so that we can, continue to work together.
Love it. And I guess to maybe kind of wrap up this deep dive, right? We talked a lot about different things, but if there was like top 2 or 3 things that you guys think the listeners should be really mindful about when it comes to underwriting, what might those 2 or 3 things be, Jarod and Dayne? What would you recommend them to kind of really pay attention to?
You want to go first, and then I can make fun of your answers, or?
Number 1, have Jarod do the underwriting. No, I would say conservative underwriting, conservative. It's real easy to pencil whip a deal and make it look like it's going to produce $1 million a year. But you can't live in fantasy land. You have to live in the big boy real world. And so, almost plan to fail. Make sure that you're not overestimating what you can get rents to. Make sure you know what the taxes are going to go up to, because taxes kill almost every deal that we look at. And that's something that you need to be very aware of. Make sure that, when I do sit down and do a real in-depth underwriting, I'm going through it 2, 3, 4 times to make sure that it makes sense, and that I didn't miss anything. If your expense ratios are either really too good or too bad, there's something going on there. So the big thing I would say is you have to be conservative, especially if you're bringing in investors, because we said this last night, is we protect their money much more than ours. If we lost somebody's money by aggressively and stupidly underwriting a deal, I would be devastated. And so the conservative and realistic underwriting process is a must. And then, the only other thing I would say is you have to get a finger on the pulse of that deal. You have to know what is our expected tenant turnover as soon as we take this over. CapEx, what, did you walk every unit and get proper and accurate estimates for whatever you're going to have to do to that property to bring it up to snuff, and then allocate, for that in the underwriting. You have to have a good grasp of that.
Yeah. I think he said 1 to 2. That was like 50, but no, I mean, to Dane's point, 100%. I mean, we are very conservative, and honestly, that may actually have, when the market was hot, we may have lost deals because we just weren't willing to make certain assumptions. But yeah, I'd be conservative, and then honestly, like another set of eyes. I mean, I joke around with him all the time, but you can just get lost in the numbers, and somebody to just look at it differently, to see something like, hey, that expense ratio seems way off. I think it's just great. Just because having another set of eyes is never going to hurt on something like that. So yeah, I'd keep it simple, keep it conservative with your assumptions, and be surprised on the upside, and then have somebody double check it. And then eventually get to a place where you have like a kind of systematic approach, so you don't forget certain things like, oh shoot, did we adjust for property taxes coming in? Those would be the biggest takeaways.
Yeah.
Awesome. Well, Andrea, did you have anything else to add based on your experience with underwriting a lot of deals there? Anything else you recommend for the audience to pay attention to?
There's these general rules of thumb. I feel like we're always put on the hot seat as underwriters, like, come on, what's the numbers hot seat? But, there are rules of thumbs that I follow, like vacancy wise, I usually anticipate like a 10% if it's not higher already. Bad debt collection, I would say 3 to 5%. I anticipate, and then there's like legal expenses. You're going to form a new entity. What are those costs going to be? Are you going to syndicate? There's, a lot of legal expenses that go into just the acquisition of a property and making sure that you incorporate your own LLC for the property, and then an LLC that operates it, and another LLC that is able to manage the money. So I guess do you guys follow any rules of thumb for your underwriting?
We have some. We've gotten away from some of them with just more, again, kind of expected performance with input from the property manager. So instead of having like a hard and fast rule of, hey, we think repair and maintenance costs are going to be, between $450 and $600 a door, we are really just getting input from our property managers. And I kind of use some of those rules of thumbs to again, sort of gut check certain things. But we got bit on a deal where it was all kind of rules of thumb and less, are those rules applicable for this property in this area? And so that's where a lot of this more, collaborative approach with our property manager came from. Is we need their experience, since they are the ones truly running the property for us. We need their experience and their input on these numbers, or else they're just numbers on a spreadsheet.
No, I love that. I think this has been an amazing conversation, guys. So much value, and thanks for providing and talking through some of the rules of thumbs, and also clarifying for people that rules of thumbs are just rules of thumbs. Nothing really beats experience. Nothing beats having a property management company or a contractor walk the property with you. Well, hey, so if the audience wants to get a deeper learning about underwriting, we're actually planning to have Jarod walk through his underwriting spreadsheet, his whole process live on YouTube. If you want to be informed of this next live, please follow us on Instagram, subscribe to our YouTube channel at youtube.com/@Kent_he, and make sure you follow Aspen Realty Co's website, get onto their newsletter so you can actually be informed of the next live session as we go deeper and deeper into the entire process of buying a property in multifamily that's related to affordable housing from beginning. So Dayne, Jarod, Andrea, thank you so much for coming on to the show today. This has been an amazing conversation. I had a lot of fun. I had a lot of laughs. So thank you guys, and we'll have you guys back on soon.
Absolutely.
Thanks, Andrea.